Everyone thinks 2025 was great for safe money. Bonds went up, yields came down, portfolios finally breathed again. But here's the part nobody is talking about. A hidden signal buried inside the bond market says 2026 is going to crush people who stay safe. And while retail investors are celebrating last year's returns, smart money is already repositioning. This is not a crash warning. This is worse. This is a wealth trap. For most people, safe money means one thing: government bonds, high-grade corporate debt, long-term treasuries. The logic feels bulletproof. Governments don't default, big companies don't disappear, bonds pay you to wait. And after years of pain, 2025 rewarded that belief. But markets don't reward comfort twice. What worked yesterday often becomes the trap tomorrow. In 2026 is shaping up to be a year where old money habits quietly underperform, while new opportunities punish anyone who refuses to adapt. Let me show you why. Let's start with what actually happened. In 2025, the Federal Reserve cut interest rates by about 75 basis points. Bond prices rose sharply. Investors enjoyed the best bond returns since 2020. Morningstar U.S. Core Bond TRYSD Index, 10-year returns. Look at this chart carefully. You'll see something important. Returns hovered modestly for years. Big drawdowns scared people away. Then suddenly, 2025 spikes to about 7.3%. That number matters. It told investors, safety is back. But markets don't speak in headlines. They speak in timing. And timing is where most people get it wrong. 2025 was a perfect environment for bonds. Here's why it worked so well. Falling interest rates pushed bond prices higher. Older bonds with higher payouts became more valuable. Corporate profits stayed strong, keeping risk low. In simple terms, the economy was good and money was getting cheaper. That combination doesn't last long. And history tells us something uncomfortable. When bonds deliver their best returns, future returns usually shrink. That's not pessimism, that's math. Now we move into the dangerous part. The market is already pricing a very different 2026. Here's what's changing. 1. Smaller rate cuts. The Fed is expected to cut rates far less, around 60 basis points. That means less downward pressure on yields, less upside for bond prices, less easy money from safety assets. 2. Fiscal stimulus is coming. Tax cuts, spending increases, economic acceleration. Sounds good, but here's the twist. A stronger economy often keeps long-term yields elevated. U.S. 10-year Treasury yield. Watch this line carefully. Even when short-term rates fall, long-term yields can stay stubbornly high or even rise. And rising long-term yields are poison for long-duration bonds, retirement-heavy portfolios, set-it-and-forget-it money. This is where many investors get blindsided. Most people don't understand duration. They just know long-term bonds pay more. But here's the psychological trap. When yields rise, long-term bonds fall harder. That means bigger price drops, slower recovery, years of lost opportunity. And professional investors already see this risk. Many institutional managers are doing something retail investors aren't. They're reducing exposure to long-term bonds. Not because bonds are bad, but because the risk-reward balance has changed. Smart money doesn't argue with the market. It moves ahead of it. Now let's talk about something even more revealing. Investment-grade credit spreads. What do you notice? Spreads are extremely tight, near historic lows, close to levels not seen since the late 1990s. This tells us something critical. Investors are being paid very little extra to take corporate risk. That's fine, until risk shows up. And risk is quietly building. Why? Tech companies are expected to issue more debt. Corporate leverage is rising. Even small economic shocks can widen spreads. When spreads widen, bond prices fall, returns shrink, safe portfolios suddenly look fragile. This is how wealth erodes quietly, not in crashes, but in underperformance. Here's the lesson most people miss. The wealthy don't chase safety. They chase positioning. Safety feels good emotionally, but wealth is built through adaptation. Old money says, preserve capital at all costs. New wealth thinks differently. Where is capital about to work harder? When the market shifts, safety becomes expensive. Stability becomes slow. Comfort becomes the enemy. The rich understand this cycle instinctively. They don't panic. They don't overreact. They rotate. This is where 2026 becomes a dividing line. Old money mindset, heavy long-term bonds, blind faith in historical averages, waiting for rates to save portfolios. New opportunity mindset, flexible duration, tactical allocation, understanding macro cycles. This isn't about abandoning bonds. It's about using them intelligently. In 2026, shorter duration instruments may outperform. Selective credit may matter more than broad exposure. Cash flow strategy beats yield chasing. The winners won't be the safest, they'll be the most aware. Here's the brutal truth. Most investors look backward. They ask, what worked last year? Smart investors ask, what's about to stop working? 2025 success is emotionally anchoring people. It makes them overconfident, lazy, resistant to change. That's how wealth traps work. They don't scare you, they reward you first. Let's be clear. 2026 is not about fear. It's about transition. The biggest risk isn't volatility. It's staying loyal to outdated safety. Old money will defend comfort. New opportunities will reward adaptability. And the quiet truth? Smart money is already moving. Not away from wealth, but toward where wealth grows next. If you think safety means standing still, 2026 will teach you otherwise. Wealth doesn't disappear. It changes hands. And the question isn't, is this asset safe? The real question is this still smart? If you want to understand how elite money thinks before the shift, subscribe to Elite Money Club. Because by the time the headlines change, the smart money is already gone.